Hey guys, thanks for jumping back into the Cryptoverse. Today we're actually going to be doing an expansion on a previous video that I did for Bitcoin. So just a shout out to this person who said, it would have been far more meaningful if it was based off the percent delta from average of prior period price, as it is the average price of the past 8 years is completely skewed by the current year. And it is a decent point. I mean, Bitcoin being at several thousand dollars would obviously skew older data. Um, so let's jump into this idea. I've mentioned many times that I do read the comments, and I would like to create stuff that you guys can use. So what I did was I just made a spreadsheet that essentially looks at this idea. If you were to take the price of each period and look at the deltas between each price, when would have been the best time to buy? So this basically is going to give you as good data as you're going to get for this type of analysis, in my opinion. So first, you can see we've broken it down by year and then by day of the week. Here we've broken it down by year and month of the year, and then year and which quarter it is. And if it's green, if it's negative, then that means it's lower than the average price of that period of that year. So what we're gonna do is just look to see if there's really any trends here. And there's really not a whole lot that we can go off of, but there are some things. So as far as day of the week is concerned, and I mentioned this in the other video, nothing really is that statistically significant. Um, I don't really know that there's any huge trends here based on day of the week. Um, you can see recently that it would have been bad to buy on Monday and Tuesdays, but that hasn't always been the case. If we jump into say the month of the year, then we can see that during our big bull run of 2013 and 2017, then clearly you would have wanted to get in early. And then the preceding year, so 2012 and 2016, look kind of similar. So this one is pretty similar to this one. And the bull runs of 2013 and 2017 are pretty similar. And then the bull market of 2014 and 2018 looks somewhat similar. I mean, they're not identical, but definitely in 2014 and 2018, you did not want to be buying in the beginning of the year. And then 2015 and 2019 started off very similar, but then 2019 had that larger run. Now, if we look at quarters, so this is where maybe we can actually find more useful data. If we look at quarters, then you can see. So the reason why we have this over here is just because we just don't have price data for there, just like we don't have price data for quarter four. Obviously, we have some price data, but unless we have the entire quarter, I ignored it. But the interesting thing is, you can see in 2013 and 2017, you wanted to get in those first three quarters, and then the preceding year, you wanted to get in the first two quarters, okay? And then in the bear markets, obviously, you did not want to get in the first quarter of either 2014 or 2018. But then, 2015 and 2019 look kind of similar in that they are, this general idea of, buying at the beginning of the year after the year of a long bear market. So 2014 was a bad bear market, 2018 was a bear market. So then 2015 and 2019 were good times to get in. If we were at the beginning of those years, so if we were to expand this and suppose that 2016 would emulate, say, 2020, which remains to be seen. But if it were, then that means getting in the first and second quarter would be the best time to get in. And I feel like it's not that hard to understand why potentially is we're already getting close to the first quarter, and if we do see a drop going into the following year, you could imagine that throughout the entire year of 2020, maybe by the end of the year, we would start to recover some of that drop. Even if we don't see a drop, even if we just stay at 7,000, things like the halving and whatnot typically are followed by increases in the price. So I don't really think this. Oh, I post a lot of different types of analysis, and I don't really know that this one is actually going to be that helpful. But it is what it is. I look at the data, and if it doesn't really tell a story, then I'm not going to make one up. So this is more or less what the data says. Just it looks like years following bull markets, it's better to get in at the end of those years, and then the years following the bear markets, you want to get in at the beginning of those years. And then historically, the year following, kind of the year after the bear market, so 2 years after, so 2 years after the bear market, it was best to get in during the first quarter and the second quarter. So that could mean that, right now and leading into the first quarter and second quarter of 2020, potentially are the best times, are going to be the best time to get in. And it makes sense from a halving perspective, as I mentioned, because price has typically been, price typically goes up after the halving, and you could argue the difference between the 4-year and longer cycle periods, but in general, it seems like it kind of makes sense, and you guys can do with this what you wish. But I just wanted to give you guys an update because it was a fair point that more recent data does skew what the results would be. So clearly, I didn't go through every little day of the week and month of the year, but you guys can look at this. If it's green, then that means it would have been a good time to get in with respect to that year. So look at it, see if you guys see any trends or any correlations, and if you do, let me know in the comments below. Alright guys, that's it for this video. Subscribe to the channel if you guys like the content, and I'll see you next time. Bye.